So the stock market's taking a beating. We all know that. All feeling it in you're feeling it in your portfolio, your 401k, your IRA, and basically a bubble popped. It's very clear a bubble in the market has popped. The tariffs popped the bubble. That's pretty much what happened. And who knows what's going to happen? I mean, they go down, et cetera. What a lot of people aren't talking about though is the bond market. Now, the bond market is actually bigger than the stock market. And a lot of people have put 60% in stocks and 40% in bonds. That's a standard allocation for financial planners. Okay, now the reason they do that is because they go, wait a minute, well, when the stock market's going down, the bond market's going up, and vice versa. That typically happens. But what if they go down together? Then what happens is you actually have a sell-off in the stocks, right? Or margin calls because people have borrowed to buy stocks. And where do they get the money? Well, they have to go to their bonds. They sell their bonds. Okay, well, this in the worst case scenario, this can actually cause a collapse of the banking system, right? Remember when we had the banks, the regional banks collapse a couple of years ago, the reason for it was that they had to sell some bonds, okay, because they had a run on the bank. They had an old-fashioned run on the bank, effectively, and they had to sell some bonds, but they sold them for less than they paid for them. Okay, so let's talk about how that works and how bonds work so that you can kind of understand if you've got money in the bond market, here's what's going on. And even if you don't have money in the bond market, this will probably have an impact on you. So I'm going to show you some really simple math to understand really how bonds work. They're actually quite simple, but people get confused because they get confused between the difference between the interest rate and the yield. Okay, so let's say that you have a bond that is a 4% bond and it's $1,000 bond. So $1,000 at 4% every year is going to pay you $40. So you're going to get $40 on that bond, right? And let's say you paid the face value. Let's say this is the face value. And let's say this is the stated interest rate, stated interest. Okay, then you're going to have a 4% yield. The yield, if you do any real estate, you know that, it's based on cap rate, which is your income divided by your purchase price. Well, this is just your income divided by your purchase price in the bond market. They just call the same thing they'd call cap rate in real estate, they would call yield in the bond market. So in this case, your stated interest and your yield are the same. Okay. Or they're on par with each other. That's another term they use. Let's say, though, that there's a lot of demand for this bond. So a lot of people want to buy this bond, and that $40 now is still being paid on that same $1,000 face, but you have to, because of the demand, remember, bonds work just like stocks do, just like inflation does of your eggs or your bacon, right? It's supply and demand. If there's a limited supply and there's more demand, right? Stocks, there are a limited supply of stocks. It's the demand that pushes the price up. And if the price goes down, it's because there's less demand for the stocks, right? People are selling, more people are trying to sell than buy. In bonds, it's the same way. If the bond price can go up, if a lot of people want that bond. So let's say I want someplace safe to put my money. So I'm willing to pay $1,500 for this bond. Okay. So this is not the face value. This is the purchase price, right? The stated interest doesn't change. Interest is fixed. So this is fixed. Just like a 30-year fixed mortgage. Okay, it's fixed. What that produces, though, now is a 3% yield. So the person who bought it at par or face value, they got a 4% they would have gotten a 4% yield, but you're buying it from them. And now you get a 3% yield because you paid more. 40 divided by 1,500 is 3%, right? It's not 4%. So that's the yield on it. Now, in the bond market, a lot of bonds are treasury bonds. Typically, when they look at the bond market, they're looking at treasury bonds. There are corporate bonds too. By the way, there are corporations that issue bonds as well. But bonds, their stated interest rate depends on how long of a term is on the bond. It's a little like your mortgage. Okay. If you refinance your mortgage, you bought a new house and you put a mortgage on, you probably had three choices. You probably had a fixed 30-year rate, a fixed 15-year rate, or a floating rate. Okay. So we're not going to talk about the floating rate because bonds don't have floating rates. Okay. Most bonds don't. Some short-term do. But we're going to talk about 2-year bonds and 10-year bonds. They have a fixed rate. Well, if you look at that 30-year mortgage versus the 15-year mortgage, you probably notice that your interest rate is higher on a 30-year mortgage than it is on a 15-year mortgage. Why is that? Well, because the bank's taking more risk. There's inflation risk, there's interest rate risk. There's a lot of risk the bank's taking over 30 years that it's taking less risk over 15 years. And so it discounts the interest rate to that 15-year rate. The same is true if you go out and buy a treasury bond, right? From the US Treasury, or it doesn't have to be bought from the US Treasury. It could be bought on the open market, right? And you could buy it from another bondholder. So let's say that if there was a lot of demand, that yield goes down. But let's say there's not a lot of demand. In fact, let's say it goes the other way. Let's say the fixed rate, still $40, but now it's only worth $500. It's only worth $500, right? Because this is, again, the purchase price, right? Now, instead of a 4% yield, we have an 8% yield, right? 40 divided by 500 is 8%. Pretty simple. Now, people have been talking about this inverted yield curve. Okay, the yield curve is simply this relationship between short-term bonds and long-term bonds, 2-year, 10-year. So let's get a new sheet here and let's look at the short-term bond versus the long-term bond. Let's say the short-term bond, okay, let's say this was the stated rate was $30 and you paid $1,000 and the face value is $1,000, right? And so that equals a 3% yield. Remember, this is the fixed interest rate right here. Okay, it's fixed, it doesn't change. You always get $30. No matter how much you pay for that bond, you're going to get $30 for the life of the bond. So that's a short-term bond. Let's say the long-term bond, so the 10-year bond, was at $40, right? You would expect it to be higher, and it's at $40 for that $1,000. So in a market where, a normal market, you would expect this then to have a 4% yield. But what if there's a lot of concern about interest rates coming down? Now, when do interest rates come down? When the economy is not doing well. That's when interest rates come down, right? And because you have deflationary or pressure being pushed down, you have more supply than demand. If the economy is not doing well, it's because you have more supply than demand. If the economy is doing well and it's doing too well, then you have inflation. Your supply is less than your demand, right? That's what causes inflation. The same thing is true in a bond. Let's say that I'm going, wait a minute, man, I think I want I want to sign up for that 10-year bond. But there's so many people who want the 10-year because they're worried about what's going to happen. They're worried what's going to happen after 2 years. They don't want a short-term bond because they're going, wait a minute. What could happen is that interest rate could go way down on me. It could go way down on me. So let's say that there's not a lot of demand for the short-term bond and the demand for the short-term bond goes down. So if the demand of my short-term bond goes down, what happens? Well, I don't pay as much for it. So let's say I have a short-term bond, right? It's paying $30 still, but I'm not having to pay as much for it. Let's say I only have to pay $600 for it because there's not a lot of demand. More people want to sell than want to buy. Okay, well, what's that going to do? Well, now I've got a 5% yield, right? 30 divided by 600 is a 5% yield. What about the long-term bond? Well, the long-term bond right now, I mean, it's already higher, but let's say there's a lot of pressure to buy that. And let's say the long-term bond, it's still getting $40, right? That's a fixed interest rate. But now, let's say it's at $1,500 because, wow, people really want that long-term. They are so worried collectively about the economy. They want that long-term bond. Now that's only producing a 3% yield. So you can see that now this is upside down. This is right side up, 3 versus 4, right? That's what you would expect, 3 versus 4. But now you have 5 versus 3. It's gone opposite. What's that telling you? What's it saying is, wow, this is really odd. Doesn't happen very often. When it does happen, it tends to happen when the collective market, this is millions of people and trillions of dollars, and the market is saying, wait a minute, we think something's going on. And collectively, see, the market is very efficient. And if they collectively, they think this, then almost without exception, if you have this mismatch, this, what they call it, this is called the inverted yield curve, because what's happened is it's backwards. It's gone upside down. So some of you may be wondering, what do you mean by yield curve? What does that even mean? Well, so typically you're looking at the yield over a period of time. So let's say this is time, and this is the yield. Remember, the yield, another way to look at it is return on investment, right? So what would be the yield, which is the interest received on stated interest divided by the price. Interest divided by the price is the yield. Okay, so this is the yield. Interest divided by price equals yield. And let's say that typically it's just a curve because it goes up and down, right? And let's say you've got, this is your long-term yield, right? And then typically you would have short-term, right? Would, kind of just be underneath it, right? It might kind of track pretty similarly. But what if instead it gets backwards, like I said? Instead it gets backwards. So now have the same kind of chart here. This is still time. This is still yield or ROI, which is, again, interest divided by price equals your yield, okay? So now, let's say you've got the short-term rate, and what the short-term rate's doing is it's starting out here, and then it kind of goes up here. And then your long-term rate, it's here, but it goes down here. Okay, this right here is your inverted yield curve. Because normally you expect the red, the long term, to be higher than the blue, the short term. So this is long term, and this is short term right here. This would be normal. So that's the inverted yield curve. What's the opposite? Well, this would be over here. This would be the normal yield curve. So really not that complicated when it comes right down to it. Just understand that if people want long-term bonds more than short-term bonds, they'll pay a higher price for it and be willing to take a lower interest rate because they still think that's going to be better than taking the risk of the short-term bond. Well, why would that happen? Only because people are so concerned that the interest rates are going to come down. And why do interest rates come down? Probably because the economy is not doing well. So the Fed drops interest rates, the banks drop interest rate, everybody's dropping their interest rate because they're trying to get money out there, right? They're trying to encourage production. They're trying to make production cheaper. They're trying to get people to buy things. It's just a stimulus. That's what it is. So they're trying to stimulate. They're going, well, wait a minute. They're going to have to stimulate, which means we're going to put more money in the market, which means we're going to lower our interest rates. And so what happens is it's the market that's saying, hey, this is a problem. And so if you look at that, if you see that inverted yield curve, normally what you see is the yield curve go to the 2-year bond versus the 10-year. Just use the treasury because treasuries are considered the lowest risk. 2-year versus the 10-year. Look, that it's been inverted for some time now. That's been inverted for some time. Okay, so what happens is, well, as it gets closer to actually working its way out, right? Then what's happening is that, oh, now short-term, long-term are about the same, meaning that we're actually seeing interest rates. We think interest rates are coming down pretty quick here. That's what's going on. So that's why to be concerned. Now, why does it matter in the banking industry? Well, let's say that I paid $1,000 for my short-term bonds and I have to sell it for $600. I've just lost $400 on that bond. And if I have millions of dollars of bonds, that adds up pretty quick. That's why it's a problem. If you have the bond market going down at the same time as the stock market, and the stock market goes down, means you have to actually sell an asset. What's your other asset? Well, a lot of people, it's a 60-40 split, right? 60% equities, 40% bonds. That means that you have to sell the bond, right? Because you're paying that margin call, you're paying for some loss in your equities. Okay, but you're selling, now if you're selling the bonds at a loss and the stocks at a loss, this is a problem. And all sorts of bad stuff could happen. Most important for you to understand is that when you buy your bonds or when you sell your bonds, the yield is all based on the difference between the stated interest rate, which is fixed, and what you actually paid for it. That's your true return on investment.